Well, welcome everybody to another edition, another webinar in the Intentional Success Series. This one is entitled, What Your Numbers Tell Me and Why. And this is going to be a fun ride, folks. But before we get started, I always have to thank our sponsors. They make this possible. We appreciate them greatly. I hope you'll visit their websites, take a look at what they do for you. They're big supporters of our industry, the audiovisual industry. Nationwide Wholesale Video, of course, has been with us for years, as is AV Stummful USA, Digital Projection, the great folks at Flex Rental Solutions, and of course DWP Live and Complete Crewing, some great B2B supporters. I am, of course, your host and presenter, Tom Stimson of Stimson Group. There's all my particulars on there. I hope you'll visit me on Facebook. Say hey on LinkedIn, check out the website. So today's webinar, this is fun stuff. I'm one of the people who gets excited about numbers. I get excited about what they teach us and tell us, and the more I do this, the more I learn. And so I want to pause. I just want to take a moment and share some of this with you and show you some things that you might be able to see for yourself, or give yourself a little insight into your business. So I'm going to go through 5 P&L, profits and loss statement checkpoints that I normally look at when I'm evaluating a new company, and I'm going to tell you what they might tell me about you. I'm going to tell you what I'm looking at when I look at them. We'll talk a little bit about how to improve the results, what are the areas and that management needs to focus on based on what I'm discovering, and I'll share a few insights about what you can do tomorrow to help yourself do some of these things and just become a better learner and learn more about how to work in your business and work on your business. Now, so I'm going to describe what I call a discovery process. I have to learn something about my clients in order to help them. I can't just give them generic advice. Well, I guess I could. There's certainly plenty of generic advice available out there on the interwebs, and you can buy books all day long that will tell you how to be better at everything that you do. But when you engage a consultant or somebody in my position, our job is to personalize it and customize it and make it work specifically for what you do. And the way I do that is I begin with a process that helps me understand who you are and how you do things, so that I can give you advice that helps you get to where it is you are trying to go, as opposed to where somebody else may be trying to go. And in that discovery process, some of the areas that I look at is, I look at the business acumen of the owner. Many of us started a business because we were good at something. People wanted to give us money for doing something, and that evolved into a business. I can't tell you how often, as a matter of fact, I had a conversation yesterday with a business owner who reminded me that, 30 years ago, he started the business because he was good at something, and he's never really thought of himself as a business person. And that's neither good nor bad. It is just information. Even people who are great business people need help on some of the things that they do. So whether you are a veteran business person with MBAs and degrees and all sorts of experience, or you've been doing it for 30 years and all you know is that technical thing that brought you to the business, you still have a lot of intrinsic value that we have to take into consideration. So I look at the owner, I look at the strategic intent of the business, and trust me, it's not always obvious. I'll share a few anecdotes as we go through the presentation today. I look at the shareholder strategy, which some of us might call an exit strategy. How does the business benefit the shareholders, aside from all the other benefits of the business? I look at the resources, and this is, the people and the assets, but I also do a lot of metric analysis. And the percentages here that I'm showing you are how much they influence my understanding of what the business is. Knowing a little bit about the owner is good information. What the business is trying to do is information. Shareholder strategy, resources, these are all information, but 75% of what I understand about the business will come from metric analysis, looking at numbers, because as the saying goes, numbers don't lie. Now, We don't always interpret the numbers correctly. There is a little bit of voodoo to this. So I'm going to share with you how some of my voodoo works. So let's get right into it. What you're looking at right now, and these are obviously not a company's financials. These are things I put together by way of example, are 4 different styles of profit and loss statement. A company's financial statements are made up of the P&L, the profit and loss statement, or the income statement, the balance sheet, and the statement of cash flows. And you actually have to look at all 3 of those because they interconnect and they each have information that is unique to them. So you never get the whole story. You don't get the entire metric picture, the entire financial picture, unless you look at all of them and understand how they interact. However, we can start with one, in this case, the P&L, and learn a whole lot of things. The first thing I learned is what the financial personality of the business is. So I'm looking at 4 different types of P&Ls. One I call the tax profile, one's the insider profile, a comparative profile, and the entrepreneur profile. And I want to explain to you what each one of these means and what I learned from it. So a tax profile is the simplest of P&L statements. I often find this when the financial records are maintained by an outside accountant. An accountant set up the books for tax purposes. There's not a lot of detail. There's not a lot of things I can analyze from this kind of an income statement. It's income minus expenses gives me net profit. Very, very simple. Not a lot of classification within there. Very often, everything that falls under the same tax group will get bundled into the same thing. For instance, all payroll will be under one number, as opposed to, payroll for sales, payroll, executive salaries, administrative salaries, operational salaries, all being broken out differently. So this very simple statement tells me that it's typically what I'm going to find in a young company, a newer company, though honestly, I have clients who've been in business for a couple of decades that have income statements that still look like this because they're getting their information, they're doing their analysis about the business somewhere else. Okay? So that tells me a little bit about the sophistication of the owner. The insider profile is when the company starts to recognize that certain expenses are unique to business that they've sold. Typically, this is the what we'll see is a cost of goods sold, or COGS as you see on here, for outside expenses, outside direct expenses incurred because something was sold. So you sell a project and you have to subcontract, you have to get product for resale, whatever it might be, and these get separated out while all the other expenses get lumped into what we call overhead. So everything below gross profit is an overhead expense. So the insider profile shows me that there's a little bit of sophistication, but they're really looking at inside expenses as being simply what they are. And it's not something that we can change, but I can control what we spend outside. Now, the third profile is comparative. And this happens when the business owner starts to, or their controller or accountant starts to look at things on a job basis. They start to see that different jobs have different costs, and while they may not develop a job cost system, they will start accounting for things based on jobs. What we typically see is we get a breakdown in income between the different types of income. And there are other reasons you can get a breakdown in income. For instance, taxable income will force a breakdown in income, but I don't want to overcomplicate things with sales tax. But we'll get a breakdown in income between products, services, and generally other expenses. And then I'll get a cost of goods sold breakdown that includes some internal labor and external labor, internal resources, external resources. We'll get a little bit more detail so we have a better understanding of how much gross profit is generated from a sale. It's helpful, but it's still not a complete picture. The third type of personality I will see is the entrepreneurial personality, where the business starts to recognize that there are actually multiple lines of business. And I would say probably 9 out of 10 of my clients in the AV space have multiple lines of business. They, and by a line of business meaning what the revenue represents is different between the different lines of business. So typically I'm going to see an organization, while they may do permanent installations, so systems integration, an SI line of business, box sales is a line of business, event production is a line of business, and box rentals is a line of business. There's 4 lines of business right there. And if there's used product sales, if there's service, if there's repair, we can get into all sorts of multiple lines of business. And the entrepreneur P&L will break down the income by lines of business. They may or may not be subtotaled as the individual lines, but all the elements are there. And the same thing happens in the cost of goods sold. And what this allows the owner to do is separate the lines of business and see how they each generate gross profit separately. You also notice that there's a shared line there saying that there's some shared direct resources that they allocate across the lines of business, maybe as a percentage of revenue, maybe as a percent of man hours, whatever it might be. So this is a much more sophisticated approach, still not the most complete there is, but what I will find, for 90% of my engagements, my clients use one of these 4 basic methodologies, and it tells me a little bit about the personality of the business. Now, what does it suggest? Well, these clues suggest to me a little bit about the priorities of the owner. The more sophisticated P&L tells me that there's financial analysis as a higher priority, whereas the tax basis P&L tells me that the owner is primarily concerned with what they can take home, and they spend a lot of time actually working in the business. A P&L personality will tell me what's the driving personality of the business, sales, operations, or finance. You've all heard me talk about business is a 3-legged stool. It's sales, operations, and finance. In the ideal business, all 3 legs are equal. In other words, each one has an equal influence on the business, and we have to work with them together. But in small businesses, very often the company will take on the personality of whatever it is that got the owner into the business. And I deal with all types. I deal with sales-driven organizations where the view of the world, the view of how money is made, and what identifies the business are all coming from a sales point of view. And it's typically because the owner is a salesperson. An operational company is, well, obviously we have an operationally driven owner who will influence that these are priorities. And then there's finance-driven organizations, yes, there are, where the owner is most in tune with finance, spends a lot more time doing analysis and looking at things from a financial point of view. One of these 3 is going to be in charge, and that helps me understand how to interact with that business. The P&L is also going to tell me a little bit about how far along in evolution the business is. Just because the company is 30 years old doesn't mean they're extraordinarily evolved. And I deal with some very young companies that are quite well evolved. So, the age of the company is not the determining factor to the level of sophistication that they have. And then ultimately, since the discovery process begins here, but it doesn't end here, it gives me some ideas about what kind of questions I can ask and expect to get useful answers from. So I'm probably not going to get, I may ask the owner of a tax-based P&L some detailed questions about job cost, but I may not expect to get sophisticated answers. However, sometimes they may just simply do their record keeping somewhere else. So you still ask, but sometimes you're going to be a little bit surprised. All right, let's take another approach here. Another thing that I look at when I'm trying to understand what your numbers will tell me is revenue. I'll just look at a 5-year revenue analysis. And I'm going to look at it several different ways, and I'll walk you through the 3 different ways I typically do this. So what we have here is on the screen is a company over 5 years. We see their income for 6 different categories, product categories. And you'll probably recognize right away that this is a company that has 2 lines of business. One of the first things I'm going to do is take a look at, well, actually, one of the first things I'm going to do is I'm going to look at compound annual growth. That was out of order, and see how quickly or not this company is growing by product category. So there's a quick calculation. I just pop in a column there. It tells me a little bit about the business and where they're doing well. And what you can see right now on this chart is in this organization, which is clearly a more rental-based organization, probably an event production company, and we've broken out their rental-based revenue and their labor revenue separately. And you can see that they're a good-sized company. This is a $6 million company in 2015, but their growth rate is extremely flat. 1% growth in rental, 3% growth in labor over 5 years. Now, I think we can all safely say that we've seen the economy grow at a much better pace than that, particularly in our segment. So when I talk about growth, I'm not comparing it to the GDP of a given region. And GDP is the amalgamation of all the different growth rates in all the segments, the amount of productivity of an entire nation or even a continent. However, in a particular segment, for instance, in the live event rental services industry or the production rental segment, we've been seeing 8 to 10% growth rates over the past 5 years. So this is not a very healthy growth rate over 5 years, but it is simply an indicator that something that I need to look at and understand. The other thing I look for on a quick revenue analysis is windfalls. Now, this organization has a secondary line of business, product for resale and service labor. So we're going to assume this is installation and maybe a combination of installation and box sales. It's had 2 windfall years, 2013 and 2016. 2013, it did $1.2 million in product and service. And in 2016, it did $3 million. Okay, these are significant windfalls for a company that's only $7.5 million large at the time. However, the next year they don't do that. So that's going to tell me a little bit about the business. The other thing I would note is, as we look at this, is miscellaneous income. The miscellaneous income in a less mature organization, a less sophisticated financial organization, is going to have a lot of misclassified or unclassified income. And as a company becomes more sophisticated and they find the right places to put these numbers, that number tends to go down. So having a negative growth in something like miscellaneous is actually a good thing. But the overall growth of the company is actually negative. One more thing to note is whenever this company does a boost in its windfall business, its core business takes a dive. So in 2015, rental labor together was $6.4 million. And in 2016, during the time where they had a $3 million integration project, their rental business dropped down to $4.9 million. That's a huge, huge delta, but we see this all the time in this kind of an organization. So the clues in this particular scenario tell me some things. It suggests to me that the owner is reactive. We're dealing with the shiny object of the moment. And when there's a windfall piece of business, it sucks up a lot of energy and a lot of focus. It often tells me that the owner is probably involved in the sales process, but they could be involved in the delivery process because that becomes very cumbersome during windfall years. I'm going to look into cash management because windfall companies often have cash management issues. It's that feast or famine of cash creating a tax burden, which is a cash demand that companies often don't plan for. So I'm going to look at that and see how much of an issue that might be. And obviously, I feel that the pipeline is compromised. The sales pipeline is compromised. If we sell one thing, we stop selling another. We're not selling for continual growth. And that's a little bit concerning to me, but I'm not going to draw conclusions. I'm going to do deeper investigation. So There's probably some operational constraints that says the operation serving both lines of business can't handle more work. It's using the same resources for all the revenue. So we have operational constraints I want to look into. Now, what it tells me is I've got to check everything. Okay? This is a type of organization where everything is suspect. We need to look at all the different elements of the business to find out what we can do to help this organization grow and prosper consistently. So here's another revenue table. And this one represents what I call a regular growth. Now, the good news is we have positive annual growth. Yay. The bad news is that it's not consistent. So we have windfalls that are happening on all of the business. Even though the total income is generally growing, we're going from $5 to $10 million over 5 years. That's a nice growth rate. In between, we're bouncing around a little bit because we're having some windfall years. And just like the last organization we looked at, when there's a windfall, the other side of the company seems to suffer a little bit. So when we're looking at windfall organizations that are more equitable about where their windfall is, in other words, a windfall could happen anywhere, we're looking at some different clues. So one thing that this suggests to me is that the owner is actually working in the business. So we talk about owners who work in their business versus owners that work on their business. A owner that works in their business gets caught up in the details. They're actually responsible for part of the sales, the operation, or the finance side. In other words, other people are dependent on them doing a job. They're not overseeing, they're integral. And that's difficult to do. You have to react to the demands of your job, which means sometimes you don't get to look at the entire business. You don't get to work on the whole business. So I'm expecting to find an owner that's working in the business. I'm going to look to see and check to see if there is actually a functioning management team. Now, getting the kind of growth that we saw in the last chart suggests to me that there is a management team in place. It would be difficult to have those kinds of numbers without one, but are they completely functional? Is it a complete management team? And are they steerable? In other words, can we give direction to the management team and get better results with a little bit of input? There are clearly growing pains, as we can see from the little bit of up and down in the overall revenue and the fact that the windfalls are affecting the other side of the business. And we'll have to talk about the overall strategy. Sometimes when you have multiple lines of business, we find that the strategies are conflicting, where the overall company doesn't have a clear strategy, while the individual lines might have strategies that are undermining one another unintentionally. Which leads us to the question of whether or not we need more selective revenue. In other words, maybe 14% growth is more than this company can actually handle effectively. Maybe they need to scale at a slightly lower rate. But we don't know the answer. We just know where to start looking in the next phase. So here's the third scenario of a revenue analysis that I run into. And as you'll see, this one looks pretty darn good. We've got consistent growth in both lines of business. We've got a compound annual growth across the entire company of 19%. Everything seems to be growing at the same pace. We see the miscellaneous income dropping nicely, which is what we want. Even the delivery, we'll talk about secondary revenue streams in a little bit later, but here we have a delivery income that's actually increasing faster than the business is growing, which suggests somebody's trying to do something. So here's a nice healthy looking revenue analysis, but what does it tell me? Okay, I've got growth rates in both segments that are working, and I think I'm finding an owner that's actually working on the business. So that's what I suspect I'll find. An owner that's working on the business, they're aware, they're scanning the entire business all the time. My job, or any outsider's job, is to help reinforce their efforts, supplement where they might be deficient, support their management team in whatever way that we can, make sure that they're putting equal effort into their strategy and their operations and their marketing and business development and their sales efforts. Um, we, in growing companies, I'm going to spend a great deal of time looking at operational efficiencies. The way that a company runs when they're, a $4 million business is different than how they operate at an 8, 10, or $20 million business. Operations has to make continual adjustments all through the growth cycles. So a company that's growing at, the 15-20% compound annual growth is going to feel growing pains, and the operation has to continually evolve. And there are assumptions about what makes sense will need to change depending on the size of the business they are. So we'll look at those. We'll look at their best practices, make sure that they are staying on top of things. Also, when I see a healthy 5-year growth pattern like this, I'm wondering if they've taken full advantage of elevating their strategy. Could they have grown faster? I worked in an organization that went from over a 5-year period, went from 5 million to 20 million. It's a huge growth rate. What got them there? What thinking allows companies to go in a strong economy, like we've had the past several years? We are seeing companies that are growing at a much faster rate than the average inside of an industry. Now, some questions I'm going to ask when I get done with my quick revenue analysis, and as I start to dive into the organization. So I sit down with the management team or the shareholders, and I'm going to try and discover how much of the revenue is actually intentional and how much of it is reactive. Are they simply just doing the business that, the phone rings, the emails bing, and we just do business and more business just keeps coming our way? That's reactive. How much of it is intentional, and they actually try to get the business, and the business that they're growing is business they specifically sought? I'm going to look and see whether the firm's self-image matches its revenue trends. I recently had a conversation with the owner who admitted that his company was rather stagnant. And what he told me was they were a specialty company. They were very niche. They had one specific line of business that they worked on, and that's all they really wanted to do. But as we dove deeper into the conversation, what I found that his self-image didn't match reality. And the reality is they were not growing in niche. They had a very broad-based business, a full-service business, not a boutique business. That's what was actually growing. That's what was becoming a bigger part of their business. So their overall revenue was flat. The part that they identified with that created their self-image was actually shrinking, and another part of their business was growing, another type of business. So we need to understand, where the disconnects may be, because it tells us where to help. Maybe they do need to be a niche boutique business, or maybe they do need to be full service, or maybe they need to better manage the two customer segments. How much of the revenue is strategic? And by strategic, do I mean we intentionally did some things to get a specific type of revenue? Did we add a product line? Did we add a service line? And did we work on incorporating it into the business? Or did it, as often happens, did it just occur? We woke up one day and all of a sudden we were doing a lot of this service stuff. All right, that's not strategic. Sitting down and doing a business plan, however, is. So I'll ask some of those questions before we start to dive in to the next area. And I'll remind you guys, if you have questions, I know I go fast on these things and we're sharing a lot of information very, very quickly. But if I'm generating questions, don't hesitate to type them in. I will get to as many of the questions as I can. I see a couple in here already. Service to product mix. So another thing I'm going to look at is what's the ratio to people, revenue generated from the work that people do versus revenue generated from the work that products do. If you're in the integration business, there's a certain amount of a particular job that comes out of a box, and there's a certain amount of the job that comes from human effort. We're going to assemble, we're going to install, we're going to program, we're going to service, we're going to design. So in our industry, almost every type of business I deal with has a little bit of both. And we want to see what the ratio is between those two. So I'm looking here, and what I'll do is I'll make up a little chart like this where I gather for each line of business all the product revenue and all of the labor revenue and compare them and see what our ratios are. For instance, in 2013, this company had $2.7 million worth of integration business. Only $700,000 of it was labor, which is a 35% labor to product ratio. Now, without judging whether or not that's healthy or not, I can look at the trends across the line and see how that's working all the way across the line. Okay. So I will say, great. Every year this seems to be getting better, but ooh, there's a little hiccup between 16 and 17. So I might want to drill down and find out what caused that trend of improving labor to product revenue to suddenly take a dip. Now, my prejudice is that labor is always going to be better revenue. Service revenue is always going to be better revenue than products. You have more control over it. The profit margins are huge, and it is not a commodity. Our products, our rental revenue, and our boxes are generally commodities. What we do with them is what makes us valuable. So I'm looking for healthier and healthier ratios on these things. The second line of business I'm looking at on this chart is their rental or the production rental business. And I'm seeing an opposite trend. I'm seeing the labor revenue going down. Even though there was a nice bump in 2014, we don't know why. We might start asking the questions why. It starts to fall off again in 2015 and on. And that's a concerning trend. Now, what's the right ratio? That's a longer question because it really depends on where you fit into the industry and the type of work that you're doing. Clearly, a company that does a lot of transactional rentals is going to have a lower rental labor revenue than a company that does full service events, which should have a much higher one. You know, ultimately, in both integration and in live events, I'm looking for about a 1-to-1 parity. I mean, that's my goal. I'd like the two revenue streams to be about equal. I find that that's the easiest way to create a healthy company. Let's see. I got a question here, and this is a question that fits right with the screen. It says, what would a healthy service labor revenue to product equipment revenue ratio be for an in-house AV model? And that's difficult. That's a difficult question because in in-house audio-visual services and third-party rental services, everything's generally lumped together. We get, a lot of times the service comes with the rental, it's not necessarily separated out. So there's not a answer for that. It also has to do with how your commission structure works. So what is commissioned and what is not. So we have to actually answer that one and look on an individual basis. However, the generic answer is we're always trying to improve the revenue for service because it requires less rental, which is less capital investment, if that makes sense. So thank you for the question. So what do some of the clues suggest? When I see a ratio that's not going in the right direction or has not reached the level that it should be, I'm going to look at their market rates. I'm going to try and understand where do they think value comes from in their revenue. How are they presenting value? Sometimes, I mean, and trust me, I've been in the business for a long time, like 35 years. Where we made money in the 80s is completely different from where we make money now. Matter of fact, we used to do a lot of labor just for free. We didn't charge for it all, whether we were doing an installation or we were doing a rental, because the margins on the product side were incredibly high, which I think we would all agree is not true anymore. I'm going to look into the sales process and the sales and how they qualify customers. Poor qualification of customers will lead to diminished margins, and the scariest place for margins to diminish is in labor. So this is something I want to drill down into very, very quickly. Sometimes I will look at marketing because perhaps sales isn't able to get higher margins because the market position or brand position of the firm isn't credible enough to demand it. Sometimes we're not as good as the rates that we want to charge, and the market will tell us. I will also look into whether or not there's an internal subsidy. And what this often means is that labor becomes the area that gets discounted, though I know none of you believe that you discount labor. I find labor discounting in a majority of the organizations that I work with, and they do it through subsidizing pricing, not charging for labor, doing value-added services. All of these are subsidies provided by labor that could have been revenue. So these are both sales and operations issues that I'm going to look into. Now, some questions as I drill down into this mix is I'm going to ask about the budgeting process. I want to know how they get to the numbers and how do they get that mix and who influences it along the way. I want to look at how the base prices or costs are actually determined. Very often I'll find that assumptions about labor costs are incorrect, and that's affecting what the go-to-market price actually is and what they're willing to negotiate. What are the negotiating points that are provided in the sales process? There's going to be a negotiation. Nobody gets through life without negotiating on revenue. The question is, where does the negotiation manifest? So I want to drill down into that. A fourth area that I'm going to look at has two components. One of them is the labor cost to trends. And if you're wondering why I'm spending so much time talking about labor, go look at your P&L. It's 50% of your cost. 50% of your business is related to the cost of labor. So yes, we're going to spend a lot of time. And this is a variable. There's a lot of intangibles in this. So this is where we're going to find profit. This is where we're going to find value in an organization. Most of us are pretty good at taking a hard cost like a utility or rent or the cost of a product that we're going to resale and converting that and using that number. Labor numbers get lost in all the different permutations of, HR and time off and inside and outside labor and scheduling and entitlements. So I'm going to do a quick labor to profit analysis. The top line is the labor cost to revenue. So my overall labor cost that the entire organization, including the owner, goes into this number. Okay. And I'm going to compare that to profit. And what you see on the screen is what I typically find. I typically find that labor costs are going up and profits are shrinking. And these things are moving further and further apart. But in this particular example, I'm showing you in period 2, year 2 of this, that there's a nice little bump. And if I start asking questions about, well, what happened this year? You had 19% net profit and your labor costs were the lowest of the 5-year period. What was going on? And typically what I'm going to find is they had a windfall year. And in that windfall year, they didn't have time to add permanent costs. What they did was they just ran themselves into the ground. They overutilized their staff and outsourced resources. They probably compromised a little bit on quality. They did a lot of burning the candle at both ends, as we say. And while it looks great on paper, they know it's not sustainable. And yes, here we go. The next year, the new hires got on, they changed the processes, they reworked job descriptions, and they tried to make life better. And that put the profits back to where they had been in the past. The other thing I look at, now that I've validated a trend, is to look at what's the normal volatility is. Most of you have a seasonal business of some sort, even systems integration, which for all intents and purposes could happen equally every month of the year if you sold 100% of your capacity. But the fact is, your customers have seasonality. There's time, there's money spent at the end of the year. If you're in the education market, more projects happen during the summer. If you're in the live events world, depending on where you're located, you have busy months and slow months. So what I've done here is I've given you 3 examples of companies using the exact same revenue, but different approaches to labor. So I might find completely different results. So on all these companies, what we have is some busy months. March is a busy month. October is pretty busy. April's pretty busy. And then we have some slow months. We got the July, August, December are pretty horrible. And I suspect that this company makes money 5 or 6 months, maybe even 7 months out of the year, and breaks even or loses money on the remainder. Now, that's probably why I've been hired, is to help them with that. But in this particular one, company A uses all of its fixed labor and runs up high overtime when they're busy using minimal outside spend. So they try and keep their outside spend to a minimum. 10% is actually kind of an industry norm, 10% of revenue for outside spend. Now, company B is taking a slightly different approach, same number of employees, same amount of fixed labor, but they're trading overtime for outside spending. So they're going to increase their outside labor spend to reduce their internal overtime, and we get a slightly different ratio and a slightly lower labor spend. And then company C, we find what I will testify as probably a more healthy organization is they've minimized their fixed labor. They've actually are staffing to the average month instead of probably staffing to the busy months. They're still going to run some good overtime. Everybody's going to make a good living, but they're going to spend more money on outside labor. The good news is, in slow months, their labor spend is actually going to go down because they're not paying for full-time staff to be not too busy. And they end up getting a much better looking labor spend overall. So now these are obviously made up to make my example, but as we look at organizations, we try to figure out where can we help them improve. In this example, there's a 7 basis points difference between the labor spend of these 2 companies. In other words, company C can make $1 million more off the same revenue than company A. And I don't know about you, I could probably find something to do with $1 million. Now, so I do these 2 quick analyses, and now I've got some clues. The clues might suggest that if labor costs are rising, then processes may not be evolving. So when we start seeing situations where labor goes up and up and up and profits aren't, then I'm going to look at processes. It's not the labor costs that are probably at fault or completely at fault. It's probably the processes. We're not getting more efficient as the company grows and evolves. If there's volatility, that's an indication that there might be a missing customer segment. And this will come as a shock to many of the production rental companies on this call. It is possible to have a 12-month year. I have clients that work year-round pretty much at the same level and don't have significantly busier or slower months. It is possible, but you have to have a diversification in your business model in order to do it. And if I'm seeing these 2 things, I'm looking at management, I'm looking at operations, I'm looking at marketing, I'm looking at sales, and I'm going to look at strategy. All of these things can contribute to an unhealthy labor number, volatility, and worse, a combination of the 2 that are working against the best interests of the organization. The last revenue analysis I'm going to talk about today, it's not the last one I do, but these are probably the 5 that if I can only do 5 things, these are the 5 I'm going to do, is I look at secondary revenue. Secondary revenue are the things that we don't necessarily consider lines of business, but we categorize it as revenue for a reason, probably for an accounting reason, but also because it's big enough that we want to break it out. In systems integration, I'm going to see it service contracts broken out as specialty income, and I can track the related costs to that to see how well that organization is doing with it. In live events, and also in system integration, I'll see travel broken out, and I'll see scenic fabrication. So what I've got on the screen right now are 3 things that I have personally worked with clients on that we made an impact. So on the service contract one, on the top third there, I worked with a system integration company which was selling the occasional service contract, over delivering, so their costs were very high, so their gross profit on service contracts was rather low. And then they lucked into, in 2015, some extra business and started to figure things out. So that little extra business without extra cost made them realize that potentially service contracts had hope. And then we started working on that and worked on process, in other words, get them over delivering, worked on sales, increased the margins of the service contracts as sold. So now they're on a good track of running a 53% gross profit on service contracts. But they had to turn that corner and first realize that there was something that they could do. Now, travel revenue, and while these actually were where the company had much higher travel revenue than this. They were doing $4 million worth of travel revenue in the real life example. Here they're doing $500,000. But their travel costs exceeded that. So when your travel costs exceed your travel revenue, you're going to be upside down on revenue. And the more business you do that involves travel, the lower your overall margins are going to be. However, some of us are very tepid or afraid to recover travel costs, and that manifests as what we see here, some pretty darn low travel margins actually being upside down. If we can make the adjustments into the thinking and how we do this, it can become a profit center, as this example did. Same thing with the scenic fabrication. I worked with a client who was actually all but giving scenery away and doing custom scenic in order to win jobs. They're now completely opposite. They're doing a great scenic revenue, and as they've raised their revenue demands for scenic, the client respect for their work has gone up, and they're getting actually more work out of it. So some great stories that come out of paying attention to these numbers. All right. Now, some of these clues, I'm going to look for the subsidies. So if I look at these individual, secondary revenue streams, it helps me identify where else we're subsidizing. We talked about labor subsidizing discounts, but we also use secondary income to subsidize discounts as well. So often I will find that management is actually unclear on how they make money. This is particularly true in systems integration and production rental owners who have been around for a few decades, because back in the day, we made all of our money, as I said earlier, off of the equipment. And if we haven't changed our operational mindset, we're going to start getting some pretty ugly numbers here in the 21st century. And then sales skills. I do find very often that sales skills need help to keep people from selling on price. So here's some common diagnoses that I get from all of this. I do these analyses, and I often find that systems integration firms their demand is feast or famine. And that inconsistent revenue stream suggests to me that their operational capacity is limiting sales. And what I typically see going on is when they're busy, operations says we can't sell anymore, and the pipeline starts to shrink up. And then when operations becomes free again, there's no revenue to fill up that time. It's been pushed on down the road a little bit. So operational capacity will affect how that business runs. Live events are often plagued with the busy, slow months. And typically what I'll find is that they haven't made the transition from being a transactional rental business to a services business that happens to rent gear. And those are two different business models, two different types of customers and different ways of selling. If I'm finding that the profit is shrinking when the revenue is growing, I have scalability issues. Okay, I'm probably going to find that your service is underpriced, but it's also too expensive to provide, hence a lot of discussion about the labor numbers. And let's see. So this is a process. I've talked a lot about what it is that I'm looking at. Let me show you where it fits in. So this is the analysis and discovery step in a process to help an organization achieve whatever it is it's trying to achieve. It's followed by a reconciliation process We need to understand what the goals of the business are, what the vision of the owners is, and reconcile that to the business that they're actually trying to run. Then we can map the processes or remap them as it may be to meet those expectations. So we analyze, we assess what the goals are, we draw a new map on the best way to get there, and then we start to affect the expectations in the organization about how we're going to do that, which leads to the process of doing execution and then making adjustments, which is what is normal in business. What's normal about business is that you're going to continually execute and you're going to continually make adjustments. But in an intervention, where many consulting projects are interventions, we're trying to make the adjustments to get back to that revised, the reconciled business goals and vision. And then hopefully we'll get to a maintenance and monitoring stage. But maintenance and monitoring just means we're starting over again, but we're doing it in smaller batches. We might start off looking at the entire organization and getting to the execution and adjustments phase. Then we'll go back and work on little hot spots as they pop up, and we'll follow the exact same process to analyze the hot spot. So I've got some time for Q&A. I'm going to get to that in just a second. I want to talk about one more thing here. Stimson Group 2018. I just want to give everybody here a heads up, because you're the loyal followers. You're on the webinar. I've got 5 business building workshops next year that you are going to hear more about. We're going to do 12 webinars next year, one every month, that will be in support of all the things that you're trying to do with your business. We have some more sponsor opportunities. If you're a Facebook user, I invite you to come visit the AV Matters Facebook group. This is an open discussion. You can ask questions of each other, get to know your community, share ideas. This is a great place to do it. I will pipe in every once in a while. I will offer up an idea or subject matter every once in a while. So stay tuned. We're not done yet. There's a lot of cool things coming up. So while you're thinking of additional questions you might want to ask, let me give you a couple of questions that I expect folks to ask. And the first one is, why isn't gross profit one of your revenue review points? And there's a good reason for that. No two companies measure gross profit the same way. As you saw from the first 5 P&L examples, or 4 P&L examples I showed you, they all got to gross profit a different way. One of them didn't even have gross profit on its P&L. Everyone does it different. There is no standard, and there is no accounting principle that defines a standard for gross profit. But we will look at it, but I won't look at it as part of the discovery, because we have to understand how this particular company does business. Net profit, likewise, is also not important in my review. Most of the companies I work with are in the US and are S corporations. An S corporation, the profit passes on to the shareholder, who pays for taxes through their individual taxes, as opposed to a C corporation, which has shares of stock and taxes are paid through capital gains. Now, without getting into the whole diatribe about the differences, net profit is not important in an S corporation, because the owners are typically going to try to minimize it to minimize taxes. They're going to do it through reinvestment. They're going to do it through timing. There's a lot of things they're going to do to minimize their net profit. So it's not the best indicator of health or how well the company is running. It's simply how good of a tax advisor that they have. And then normal or ideal metrics. And several of the questions in the question queue right now are about what is normal or ideal. I'm looking for what's normal or ideal for an individual company, though there are some industry standards out there, and there's certainly some survey reports. There's some surveys that I've done over the years, which I take into account. I have some opinions about those things, but first thing I want to know is what's going to be normal in that particular company, because a cost of labor for one business model is going to be different than the cost of labor in a slightly different business model. And then the other question that I often get is business valuation a good indicator of health? No. Business valuation is business valuation. It's somebody else's opinion of what a company could be worth based on a number of different scenarios. Now, it does have an equalizing quality, and I might do a business valuation and an analysis of a company, particularly if the goal is an exit strategy. However, it's not always the best indicator of health. Potential to me is a better indicator of health. The ability to execute on plans, the ability to do intentional things, to me is probably a better indicator of health. All right, so I got a couple questions here. One, what's the name of the Facebook group? Well, the Facebook group is called AV Matters, and it is a group. It's not a page. You have to join. I'd be happy to let you all in. Take a look at that. Actually, if I go back here, yeah, if you go to facebook.com groups.avmatters, you'll find it, all one word. Another question, can you recommend where to find some of those surveys that show normal ranges of metrics for AV rental production houses? I'm probably the best source for information on AV rental production houses. Sorry to say it, I have not updated my survey in a number of years, but if you'll contact me individually, I'll talk a little bit about, help me understand what it is you're trying to look for, and I'll see what I have that I can share with you. And let's see, so let me scroll back up here. There's another question I want to answer. Is labor cost measurement over time based on gross or net revenue? In my examples, it would have been based on the gross revenue. So net revenue is a vague term. I don't know what net revenue is in this case, but if that doesn't answer your question, shoot me an email. I'm happy to give you a more detailed response. So, I'll watch for more questions. Oh, goodness, let's see. All right, we're going to run out of time, so let me give you a quick summary here, 5 areas for growth. Once we do the analysis, once I start to look into an organization, I've got 5 different areas that we work with folks on. One is strategy. We figure out, why are you in business? How do you make money at it? Who are your customers? What are your values? What's the unique difference for your business in the marketplace? And then also, what is your recipe for success? A lot of people stay away from strategy. Strategy is boring. Strategy is voodoo. But the fact is, without strategy, it's very difficult to get the kind of growth that many of you would like to have. The next area we look at is operations. Now, I'm an operations guy. I'm an operations freak. I love operations. Operations' job is to turn revenue into profit. Okay. I like to say put the logic into logistics. Your logistics are moving people and products around. Operations is one of my favorite things because the opportunity for continual improvement is always there. You can always be improving operations and reducing costs, getting better results more consistently. It's a great area to have some fun. Marketing and business development, where I've spent a great deal of my time the past couple of years. The AV industry has discovered that it cannot survive without good marketing, and that pipelines do not grow without good business development. And this is different from sales. Marketing's job, as you've heard me say, is to soften the beach, help establish the brand, and business development is the filter to get ideal customers back to the mothership so that we can turn them into opportunities and eventually sales. So that's another area that we're going to work on. Sales is also where I've spent a great deal of time, particularly in the past year. And we work on pipeline management. We want mastery of pipeline management. I want to help salespeople preserve, then create value. So you've got a book of business you need to preserve, but you need to be able to create more value. And then you've also got to manage your career. If we have successful salespeople, they're doing all of these things. They're gonna benefit your business. Everybody wins. And then the last area where I'm going to spend a lot of time focusing for growth is management and finance. Management is what's leading the process. They're also managing the people who manage the processes. Finance has to count the right things, and together everybody has to create shareholder value. And if we can effectively work in all 5 areas, we're going to have a very healthy, successful company that can scale, it can grow, it can take on new things, and have happy customers, happy employees, and happy shareholders. That's the goal, right? So those are the things that, by the way, that happen to be what 5 workshops next year are on. So we're going to have workshops on strategy, on operations, on marketing and business development, on sales, and on management and finance. So look forward to more information on that. Check your email box. You'll find it in the Intentional Success newsletter, which hopefully you are subscribed to, or the AV Matters newsletter. But if you're on the mailing list, you will hear about it. We look forward to including you. So shout out again to our sponsors. If you've got questions for me or you want to learn more about what I do, just go to my website, click on Contact, schedule a phone call with me. The tool is right there. Happy to chat with you. Anybody who's done it before knows that I'm very generous with my time because I love talking about the AV industry. So if you've got a question, no matter how unimportant you might think it is, schedule some time. Let's have a chat. So thank you, everyone. Thank you for your questions. I will get this archived. Merry Christmas, Happy Hanukkah, Happy Holidays, whatever makes you happy. I hope you have it. And I look forward to meeting or talking to you again soon.